Welcome back to Global Market Watch. Here in InfoExpress, and if you've been following the markets this week, you know it's been anything but boring. Picture this. You wake up Monday morning, check your portfolio, and suddenly the numbers are dancing like they're at a financial disco. Asian markets are flashing red, European indices are sliding, and American futures are looking shaky. Meanwhile, economic data is coming in that's making even seasoned analysts scratch their heads. This week alone, we witnessed a perfect storm of trade policy announcements, surprising economic data, and market reactions that sent shockwaves from Wall Street to Shanghai. And if you think this is just another week of financial noise, think again. We're talking about policy decisions that could reshape global trade for the next decade, economic indicators that caught the IMF off guard, in a good way, and employment data that has everyone questioning what's really happening in the world's largest economy. But first, and I cannot stress this enough, hit that subscribe button and ring the notification bell. These weekly deep dives aren't just summaries, they're your roadmap through the chaos. Because while everyone else is reacting to headlines, we're going to break down what this actually means for your money, your investments, and the global economy. Today we're covering 5 major stories that define this week, and I guarantee at least one of them will change how you think about the current. Welcome back to Global Market Watch. Here in InfoExpress, and if you've been following the markets this week, you know it's been anything but boring. Picture this. You wake up Monday morning, check your portfolio, and suddenly the numbers are dancing like they're at a financial disco. Asian markets are flashing red, European indices are sliding, and American futures are looking shaky. Meanwhile, economic data is coming in that's making even seasoned analysts scratch their heads. This week alone, we witnessed a perfect storm of trade policy announcements, surprising economic data, and market reactions that sent shockwaves from Wall Street to Shanghai. And if you think this is just another week of financial noise, think again. We're talking about policy decisions that could reshape global trade for the next decade, economic indicators that caught the IMF off guard, in a good way, and employment data that has everyone questioning what's really happening in the world's largest economy. But first, and I cannot stress this enough, hit that subscribe button and ring the notification bell. These weekly deep dives aren't just summaries, they're your roadmap through the chaos. Because while everyone else is reacting to headlines, we're going to break down what this actually means for your money, your investments, and the global economy. Today we're covering 5 major stories that define this week, and I guarantee at least one of them will change how you think about the current. Let's dive straight into the deep end with the story that dominated headlines and trading floors this week. The tariff announcement that sent shockwaves around the globe. When new U.S. trade policies hit the wires, we didn't just see a market hiccup, we witnessed a coordinated global sell-off. Asia-Pacific markets recorded broadly negative sessions, with major indices in Japan, South Korea, and Australia all closing in the red. The Pan-European Stoxx 600 dropped a significant 1.4%, dragging down everything from German manufacturing stocks to French luxury goods companies. But here's where it gets interesting and concerning. U.S. stock futures were under severe pressure even before markets opened, suggesting that American investors were just as worried about these policies as their international counterparts. Now you might be thinking, we've seen tariff threats before, why is this different? Here's the kicker that markets really didn't like. The timing coincided with a weaker than expected U.S. jobs report. When you combine trade uncertainty with employment concerns, you get what economists call a double whammy for market confidence. Think about it from an investor's perspective. You're already nervous about how import taxes might affect global supply chains, corporate margins, and consumer prices. Then you get data suggesting the labor market, the backbone of consumer spending, might be softening. That's a recipe for some serious portfolio rebalancing. Now, just when you thought the economic narrative was all doom and gloom, the International Monetary Fund dropped a bombshell that caught everyone off guard. In their latest World Economic Outlook update, they actually revised global growth projections upward. We're looking at 3% growth for 2025 and 3.1% for 2026. And these aren't just incremental adjustments. This represents a meaningful upgrade from their April forecasts. But here's what's fascinating about their reasoning. The IMF identified 3 key factors driving this optimism, and each one tells us something crucial about how the global economy is adapting to uncertainty. First, front-loading. Companies and countries are essentially rushing to complete purchases and investments before potential tariffs kick in. It's like a global shopping spree driven by policy fear, but it's creating real economic activity right now. Second, lower effective tariff rates. This might sound counterintuitive given all the tariff talk, but the reality is that many threatened tariffs either get negotiated down or applied more selectively than initially announced. Third, better financial conditions and fiscal expansion. Central banks have been more accommodative than expected, and several major economies are actually increasing government spending. What the IMF is essentially saying is that the global economy has developed what we might call policy shock resilience. It's learned to adapt, work around obstacles, and find growth even when political winds are shifting. Speaking of resilience, let's talk about the economic story that had analysts doing double takes this week: China's latest GDP numbers. So, second quarter of 2025 delivered some genuinely impressive figures: 5.2% growth year over year and 1.1% quarter over quarter. Now, if you're thinking those sound good but not spectacular, let me put this in context for you. While much of the developed world is struggling to maintain between 2 and 3% annual growth, China is sustaining growth rates that most economists thought were no longer achievable for an economy of its size. Remember, we're talking about the world's second largest economy here, not just some small emerging market. But here's what's really interesting about these numbers: the composition of growth. This isn't just infrastructure spending or government stimulus driving the numbers anymore. We're seeing genuine productivity improvements, technological advancement, and domestic consumption all contributing significantly to growth. And timing really matters here. These strong numbers came out in the same week that global markets were panicking about trade policies. It's almost like China's economy is saying, while you're all worried about tariffs, we're going to keep growing regardless. The manufacturing sector showed particular strength. But what really caught economists' attention was the services sector growth, indicating that China's economic transformation toward a more consumer-driven model is actually working. Now let's dig into that employment data that amplified this week's market concerns, because there's more to this story than the headlines suggest. The U.S. jobs report came in significantly below expectations, but when you look beneath the surface, you start to see a more complex picture. Yes, job creation was slower than anticipated, but we also saw interesting shifts in where jobs are being created and lost. The technology sector, which has been a major driver of employment growth, showed signs of cooling. But here's the twist: this might not entirely be bad news. Some of this reflects companies becoming more efficient, automating routine tasks, and focusing on higher value positions. Meanwhile, we saw continued strength in healthcare, professional services, and surprisingly, manufacturing, which ties back to our earlier discussion about supply chain reshoring and the front-loading phenomenon the IMF mentioned. What this suggests is that we might be seeing a labor market transition rather than a labor market decline. The question is whether this transition happens smoothly or creates temporary disruption. There's one more crucial piece of this week's economic puzzle that deserves attention: what central banks around the world are signaling about their next moves. While markets were focused on trade and employment data, central bankers were sending subtle but important signals about monetary policy. The European Central Bank hinted at maintaining their current accommodative stance longer than previously expected. The Bank of Japan continues its ultra-loose policies, and there are growing indications that even the Federal Reserve might be more dovish than markets anticipated. Here's why this matters more than you might think. In an environment of trade uncertainty and mixed economic signals, central bank support becomes crucial. It's kind of like having a financial safety net while walking the economic tightrope. The coordinated nature of this dovish stance across major central banks suggests they're all reading from the same playbook: support growth and employment while inflation concerns take a back seat. This monetary policy backdrop is actually one of the key reasons the IMF feels confident about their upgraded growth projections. When borrowing costs stay low and credit remains accessible, economies have more room to adapt and grow despite other challenges. Now let's step back and connect these seemingly disparate stories, because when you put them together, they reveal something fascinating about the current state of the global economy. What we're witnessing isn't just a collection of random economic events. It's the emergence of a new economic paradigm, Think about it. We have trade policy creating immediate market volatility, but also driving economic activity through front-loading. We have employment data that looks concerning on the surface but might signal healthy economic transformation underneath. Meanwhile, China is demonstrating that large economies can maintain robust growth even amid global uncertainty, and central banks worldwide are coordinating to provide a supportive monetary environment. The IMF calls this tenuous resilience amid persistent uncertainty, but I think there's something more fundamental happening. The global economy is developing what we might call adaptive capacity, the ability to not just survive shocks, but to reorganize and find new sources of growth in response to them. Consider the interconnections. Trade uncertainty drives companies to accelerate investments and purchases, creating short-term economic activity. Labor markets shift toward higher value activities as routine jobs get automated or outsourced. Large economies like China prove that domestic demand can sustain growth even when external conditions are challenging, and central banks provide the monetary foundation that allows all this adaptation to occur without triggering financial crises. This suggests we might be entering what economists call a new normal, not the post-2008 slow-growth normal, but a higher volatility, higher adaptation normal, where economies are constantly adjusting but maintaining underlying momentum. Alright, here's exactly what I need you to do right now, and trust me, each of these steps will make you a better informed investor and economic observer. First, if this deep dive helped you understand the real connections between this week's major economic stories, go ahead and smash that like button. But more importantly, share this video with someone who's trying to make sense of the current economic environment. The insights we covered today about adaptive economic capacity, market resilience, and the new investment paradigm, these just aren't things you'll hear in typical financial news coverage. Now second, I want to hear from you in the comments. Here's my challenge. Which of these 5 stories do you think will have the biggest long-term impact on your personal finances? The tariff-driven market volatility, the IMF's upgraded growth projections, China's sustained high growth, the changing job market, or the coordinated central bank dovishness? Drop your answer below and explain your reasoning. I read every comment, and honestly, the most insightful responses often spark ideas for future episodes. Third, and this is absolutely critical, subscribe and hit that notification bell. These aren't just weekly news summaries, they're strategic intelligence briefings for anyone serious about understanding how global economics affects their money. We publish every Monday at 9 a.m. Eastern, and missing even one episode could mean missing the trend that changes your entire financial strategy. Also, I put links to all the original sources, data, and additional reading in the description below. If you want to dive deeper into any topic we covered, everything you need is right there. Look, this week perfectly encapsulates why staying informed about global economics isn't just some academic exercise, it's an essential survival skill in today's interconnected world. We've seen how a single policy announcement can ripple across continents within hours, how traditional economic relationships are being rewritten in real time, and how the most successful economies are those that can adapt fastest to changing conditions. The 5 stories we covered today, from market volatility to employment transitions to central bank coordination, they're all chapters in the same book. A book about how the global economy is learning to thrive amid constant change rather than just survive it. The key takeaway isn't that the world is becoming more uncertain, it's that uncertainty itself is becoming a permanent feature of the economic landscape. And in that environment, the most valuable asset isn't a particular investment or strategy. It's staying informed, thinking critically, and adapting quickly. Next week, we'll be diving into the European Central Bank's latest policy signals, analyzing the ripple effects of China's growth on global commodity markets, and exploring how the labor market transitions we discussed today are playing out in different sectors. I'm your host here in InfoExpress, and this has been your weekly deep dive into the forces that move markets and shape our economic future. Remember, in a world of constant change, knowledge isn't just power, it's profit. Keep watching the markets, keep questioning the headlines, and keep learning. Until next week, this is Global Market Watch. Don't forget to subscribe and see you on the next video.